Welcome back. We are about to get the GDP number out. We are expecting 3.5% growth for the GDP. This would be the second reading. 3.5% of the number, right in line with estimates. Let's see if there's a market reaction. We got a 3.5% growth number for the second reading for the third quarter, and this was what we were expecting. So it is a good number, certainly 3.5% showing growth. We're going to dig deeper into the number and show you what it says about consumer spending. And as we bring in right now, former Chief Economic Advisor under George W. Bush, Ed Lazear, to talk more about this. And Ed, it is good to see you this morning. Thanks so much for being here.
Nice to be with you, Maria.
3.5% growth for the GDP follows the second quarter, which was 4.2% economic growth.
Right.
In the second quarter, now the third quarter, 3.5%. Your reaction?
Well, obviously, that's good news. This is a considerable step up from where we were during the rest of the recovery. As you know, we were down around 2%. So this is qualitatively quite different from where we were. Now, the question, of course, is what does this signify about the future? I think everybody always wants to know what the current numbers mean for where we're going. The current numbers are the past, or obviously what we're much more interested in is where the economy is headed. I would say a couple of things on this. You just mentioned consumption is good. That was strong in these numbers. Investment has not been quite as strong in these numbers, and that's a concern. Housing, autos, obviously, are the weak spot in the economy right now. So if I were going to point to something, I'd say that would be the major concern. But going forward, I always like to use the market as an indicator. My view is that the best forecast of the future is essentially what the market is telling us. So I always base my forecast on changes in the S&P 500, which, as we know, has not been great over the past few months. And so if you look at that, the market is essentially telling us that the next 4 quarters we would expect something like 2% growth as opposed to 3% growth. Hopefully the market got it wrong and we'll be able to revise that. But right now, that's where we are.
Consumer spending was revised lower in this report, and the market is weakening here. Any reaction to what the market's telling us on this news? Is this basically saying the Fed keeps up the rate hikes?
Well, two things. One is you don't want to look at, short-run movements in the market. I mean, certainly minute to minute, but
right,
even day to day tend not to be the kinds of things that I rely on. I tend to look at something like 3 months or 6 months. In terms of the Fed, the Fed is in kind of a difficult situation right now because they probably would rather have had rates high already and have been at a place where they'd like to be, so they had some flexibility. But this is kind of the situation where you decide you're an hour late for the ball, and the question is, should you drive twice the speed limit to get there? And I don't think that's a very good strategy for them, and I think the chairman probably knows that. So
right, and we're going to hear from the chairman today. The Fed chairman is going to speak at 12 noon, Dakin, and we know that we are waiting for any expectations of what he says on inflation and this growth number. Your reaction?
I was just looking into the number. So consumer spending, it came in the initial reading, it was running at a 4% rate, and in this report, it came in at 3.6%. Thank you. I was looking through the right through on this. But in terms of interest rates, the Wall Street Journal this morning highlights the predicament that all investors will be in with the Federal Reserve and how these speeches from the likes of Jay Powell matter even more because we're going into the new year. It's fully expected that the Fed does hike at its December 18th, 19th meeting. But looking into 2019, there's a real split. Do they raise 2 times, 3 times, 4 times? That is, the outlook is really wide open. So it creates the potential for more volatility in the stock market, not just stocks, but also the bond market and across all of the asset classes that have sold off so sharply this year.
Ed, this is Mike Huckabee. What do you think is the key factor that has driven the GDP to rise starkly since the last election? I mean, I think that's maybe a burning question. And if it's something tangible that was done, why don't we keep doing it?
Well, that's a good question, and I think it's the obvious two things that people always talk about. One is taxes, and one is the new regulatory regime. So if we're thinking about how this administration views markets and business in general as compared with the last administration, it's quite a different story. So if I'm an investor, if I'm a business person trying to figure out what to do in the future, and I'm looking at the situation today versus the situation 3 years ago, this is a much more positive situation. Now, you said, what if this worked in the past, what can we continue to do? Obviously, we know there's a movement right now to try to do a bit more on the tax front. That's going to be pretty tough sledding, I think, in a lame duck Congress. But obviously, if it were to get done, that would have some effect. Most of the action would come about through the saving and investment vehicles, because that's really where the growth lies. The other stuff may be important, it may be useful, but in terms of affecting economic growth, it's primarily saving and investment that does it. If we don't have much action on that front, we're not going to have much growth from the tax legislation, even if it were to pass.
Ed, it's Kevin Kelly. As we hit home about the household spending grew 3.6%, but it was down from 4%,
Yep.
and that was because of lower durable goods orders. And we're talking about spending and investment that in order for our GDP to keep going at this. Where do you see first quarter GDP and GDP going next year? Because I can't drive looking through the rearview mirror, so we've had a great couple quarters, but everyone's worried that the sugar high from the tax cuts are going to come down.
Yeah, I guess I don't see the tax cuts as so much of a sugar high. People talk about it as a stimulus. I don't think of it as a stimulus. I actually thought of the tax bill as moving to a more efficient way of collecting the revenues that the government needs. Virtually all economists agree that the most pernicious tax in terms of economic growth is tax on capital. So the reduction in taxes on capital were a positive factor in terms of long-term economic growth. It's not just the sugar high, as you mentioned. So I would think that would continue to be a positive force. Again, going for the next quarter, the next 4 quarters, obviously the market is seeing something that it doesn't like today as much as it liked a few months back, and so that's an important caution. And I think the fact that consumption is a little lower than it was is not quite as troubling to me. But the softness in the housing market that we've seen over the past few months, I think, is a concern, and it's something that we need to keep watching.
Ed, it's Daga McDowell. Why haven't the corporate tax cuts resulted in faster business investment and business spending? Looking at this, the second report on third quarter GDP, so the consumer spending came in a little bit lower. Business spending was a little bit higher among a couple of elements. Business spending on equipment increased at a 3.5% rate. That's ahead of the 0.4% increase previously reported, but that's still the slowest pace in 2 years. So why aren't businesses stepping up?
Well, I would say it's a couple of things. First of all, there's a change in the nature of investment in the last quarter. As you know, if you look at, you mentioned durables and some of the other factors, equipment, structures have not been great. But on the intellectual property front, technology, that's been pretty good. So that was an offset there.